The U.S. government now has to borrow new money at a rate of about $1.2 trillion in a 12-month period. This is driven by ballooning deficits, the result of tax cuts and spending increases. The total amount of U.S. Treasury debt outstanding is now over $22 trillion, or about 105% of GDP. And it'll grow at a rate of over $1 trillion a year for years to come. To use a technical term, the U.S. government will have debt out the wazoo. Only a few countries are in worse fiscal shape. King of the hill, Japan, but also Greece and Italy. Unlike Greece and Italy, both Japan and the U.S. control their own currencies, which eliminates the issue of running out of money because the central bank can always buy the government debt by printing the money to do so, which the Bank of Japan is still doing. But the Fed is no longer buying Treasury securities. It has been shedding securities since October 2017, and that's the opposite of printing money. So if the Fed is no longer buying U.S. debt, who is? And more importantly, why? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, April 21st, 2019. Some of the answers come from the Treasury Department, which reports data on the holders of U.S. Treasury securities. Like just about all financial assets, such as stocks and bonds, U.S. Treasury securities are electronic entities whose ownership is electronically registered, and transfers of ownership are also electronically tracked. There are some ways to obscure beneficial ownership via fiduciary accounts in tax havens, for example. That's a relatively small percentage of the $22 trillion in debt. The holders of most of the Treasury securities outstanding are registered as holders at the Treasury Department. So who has been buying this $1.2 trillion in new U.S. debt over the past 12 months? The holders of this $22 trillion in U.S. Treasury debt can be divided into four major categories. Foreign investors are key. They hold $6.4 trillion of U.S. Treasury debt. And that includes foreign central banks, hedge funds, foreign government entities, commercial banks in foreign countries, individuals, etc. The next category is the U.S. Federal Reserve, which holds about $2.1 trillion in Treasury debt. And then there's U.S. government entities, such as U.S. pension funds and the Social Security Trust Fund. They hold nearly $6 trillion of this debt. Now, some people say this is debt that we owe ourselves, and so it cancels out, but that's baloney. This money belongs to beneficiaries of the Social Security Fund and those pension funds. This money is owed to those beneficiaries, and it doesn't cancel out. It is a real debt that the U.S. government owes, and it has to pay. So it is there and weighs fairly heavily, nearly $6 trillion. And the fourth category is comprised of American institutions and individuals. This includes corporations such as Apple that have invested their cash in Treasury bills or longer-dated Treasury debt. It includes U.S. banks that hold about $500 billion worth of Treasury securities. It includes bond mutual funds that invest in Treasury debt, and it includes individuals that hold Treasury debt directly. Of the $6.4 trillion held by foreign investors, China and Japan are the largest ones. China now holds about $1.1 trillion in U.S. Treasury debt, and that's actually down $46 billion from a year ago. China's holdings peaked in February 2016 at about $1.25 trillion, but it has since shed a little over $100 billion of this, including the $46 billion that it shed over the past 12 months. Japan, the second largest foreign holders of U.S. Treasury debt, added $13 billion in Treasury securities over the past 12 months. It now holds a little over $1 trillion. China and Japan combined hold now 10% of the outstanding U.S. Treasury debt. That is down from a little over 11% just a couple of years ago, as both China and Japan have shed their holdings and as the total U.S. Treasury debt has risen. In terms of importance to fund U.S. deficits, China and Japan are still very important, but less than they were not too long ago. Brazil is in third place with $300 billion in Treasury securities. And then there's a gaggle of entities in tax havens and in places where obscurity is more possible. And these are the City of London in the UK and Ireland, Luxembourg, Switzerland, Cayman Islands, Hong Kong, and Belgium. And beyond that are lots of countries with relatively small amounts of treasury holdings. In total, combined, they hold $6.4 trillion. And that's up $164 billion from 12 months earlier. So they have been net buyers over the 12 months. U.S. government entities, so the Social Security Trust Fund, pension funds, and other entities, they combined hold $5.9 trillion in Treasury securities. This is up $160 billion from a year earlier. The third category is the Federal Reserve. It holds $2.1 trillion in Treasury securities, but it shed $250 billion over the past 12 months as part of its balance sheet normalization. So over the 12-month, foreign investors added $164 billion. The Fed shed $250 billion. U.S. government entities added $160 billion. And so that makes for a net increase of $45 billion in Treasury holdings. The fourth category is comprised of American institutions and individuals and corporate America. And they added $1.1 trillion of U.S. Treasuries to their holdings that are now $7.7 trillion, by far the largest category. Why would companies and other institutions and individuals buy U.S. government debt in the amounts of $1.2 trillion over the past 12 months? And here's what's going on. Banks have engaged in wall-to-wall marketing to attract deposits. So I have a whole stack of these materials in front of me. One of them is from HSBC. It's offering a welcome deposit of $775, and it's offering 2.2% if you bring new money to them. And there is something from Chase. It's offering $600 to open a deposit account. And Capital One has a money market fund paying 2% interest. Then there's American Express Bank paying 2.1% on a savings account. Goldman Sachs's Marcus Bank is paying 2.25% on a basic savings account, as is Synchrony Bank if you open a new account. Even Wells Fargo has bombarded me with ads for a savings account paying 2.1% if I bring in new money. All this is new money. And banks are trying to attract deposits. And they're competing with the federal government that has to attract money to fund its deficits. The United States government is now paying between 2.4% and 2.47% on Treasury bills for 1 month to 1 year. And consumers and companies alike can buy those very conveniently from the government directly. Now, I have a little bitty company that has a little bitty cash, and my little company cannot get a high-yield savings account. Those are only for individuals. One of the options my little bitty company has is to buy Treasury securities direct from the United States government. And the government makes it easy to do that. The yields are higher than savings account, and it makes absolutely no sense to leave the money in a corporate account that pays no interest. 2.4% interest on cash that is in an essentially risk-free investment. It may not sound like a whole lot, but it is above the rate of inflation as measured by CPI, which is not a frequent occurrence in the United States. And after years of zero interest rate policy, it seems like an attractive thing to do. Many consumers are starting to look at their bank statements, and they're discovering that in their savings accounts, they're still not making any interest rates. And so they start shopping around a little bit, and they're trying to see what else they can get. And they too may be receiving these advertisements either on paper, amazingly, or on the internet. And they may start looking for other options. One of those options, obviously, are treasury bills. They're more like CDs in the sense that it's not a savings account, but with a 1 month maturity or a 3 months maturity or a 1 year maturity. These things are, you can ladder them, and there are all kinds of ways folks can manage the cash. 2.4% 20 years ago would have been a ludicrously low amount of interest to be attractive, but these days are not normal. And 2.4% is a fairly attractive number. You look at the dividend yield on the stock exchange, and you look at the options you have there. You invested in GE stock to get the dividend. The dividend yield was 3% or 2.5%. And then suddenly the company gets in trouble, the stock price plunges, and the dividend gets cut to next to zero. And this shows the risks that are now out there for yield investors. If they are going after dividends, the market is very high, and the dividends are at risk for companies that have over-leveraged themselves. And so there are other options to be looked at. And it makes them attractive for cash management purposes. That's a big part of what treasury bills are being used for, both by individuals and corporations. The fact that the 10-year Treasury yield is at 2.6%, which is fairly low, shows just how much demand there is for these Treasury securities and how eager investors are to accept relatively small yields for the safety of owning a Treasury security. So the $1+ trillion a year that the U.S. government throws on the market every year, year after year, in all future years, simply doesn't matter to investors, at least at this moment. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wall Street Report.